This blog is dedicated to understanding the costs of guarantor loans. As a comparison site, we feel it's our responsibility to make sure that applicants understand the different costs associated with a guarantor loan, and so that they can also measure them effectively. And above all, when they're looking at a comparison table on our website, they know that they're getting a good deal. So the most easy way to compare the costs is by looking at the APR. Now, this refers to the annual percentage rate, and it's taking the cost of the loan as though it were calculated for an entire year. Now, this can be good for guarantor loans because they do typically last a year, or 2 years, 3 years, 5 or 7 years. It's not as simple when you're looking at a loan for 3 months or 6 months, because it will then be calculated as though it were for a year. However, being the standard benchmark for measuring financial products, APR is a very good way to compare costs. We even give a little explanation here about how to calculate it. Your loan will be broken up into interest and capital. The capital is actually the amount you borrow, what you draw down. The interest is the rate which is simply charged by the lender. In the early days, you'll typically pay a lot more interest, but this will decrease over time. And then initially, you'll pay off a little bit of capital, but then more over time. A great thing to do is look at the representative example. Now, this is just simply a full kind of explanation. It's saying, look, if you borrowed this and you took it out for this long, this is what you'd be paying in interest, and then this is your final payment. So it's very good. It gives you an idea of what you're paying. The term representative can be misleading, and it's important that you know this, that representative only represents what at least 51% of successful customers will get. So don't be disappointed if you don't get that exact rate advertised by the lender. What it means is that maybe your loan was a bit longer, or maybe you looked to borrow for a higher or lower amount, and that's why the rate wasn't exactly as advertised. The loan duration, as I touched upon earlier, is very important, because if you've got a loan for only a few weeks or months, like a payday loan, when calculated for a year, it then becomes very inflated, like a few 100% or a few 1000%. So that's always worth considering. If you're repaying early, this would mean that your loan could actually be cheaper, because you're only being charged for the duration that you've had the loan for. So if you want to pay back in a few weeks, you'll only pay the interest for those few weeks. So it's always good to repay early. Finally, we also work with one lender that offers cashback. As an incentive for repaying your loan on time, they'll give you the last month as cashback. So whatever that repayment was, they'll send that to your bank account, and it's a nice kind of way to finish off your loan. So feel free to look at our site for more information. We've got lots of useful guides. We hope this has been helpful.